My name is Emile Westergaard, and I'm the founder of IVoT Financial Training, Inc., a company committed to providing tools and training that make financial mastery accessible to everyone. Our show is our vehicle for discussing intelligent investing from a long-term fundamental perspective. Today, our team, including financial advisor Ed Butowsky and market analyst Andrew Tang, discuss how to interpret market sentiment and why it is currently so positive when consumer sentiment is low. We also take a look at what the latest inflation data means for second-half economic and market performance. I will then lead a second quarter preview of Palantir Technologies and Apple, using our proprietary IVoT Forecaster tool to analyze and assess current cash flow trends and forecast future cash flow and valuation for both companies. Let's get started. Okay, so now we're going to go to our two financial advisory experts, Ed Butowsky and Andrew Tang, to talk about what their clients' concerns are these days and how they're advising their clients on the markets and investing.
Well, I'll tell you, Emile, what I'm telling my clients is in reaction to what they're asking, and they all believe something negative is going to occur, and I don't believe that's going to be the case. I think we're going to have sideways to lower interest rates. I think earnings for the S&P 500 companies are going to come in on surprisingly higher levels because expectations have been ratcheted down. I don't believe the tariffs are going to play any role in negative inflation, and I think that interest rates are going to drop because of the GDP numbers being slow and not because of inflationary pressures being high. That's why they would go higher. So I'm trying just to calm everybody down and say that we have a really, really good outlook for the rest of the year. Andrew, what are you telling your clients?
Yeah, the number one topic that I've been reacting to or answering is that Jerome Powell, the Fed chair, is safe until May of next year, in my view. Because the market last week reacted negatively to the possibility that he could be ousted, and you could see the yield just spiked up, and that was a negative reaction confirming that that shouldn't be done, right? The Fed should be totally independent. That's one. Second is that inflation, it's really not an issue, and that continued to be the case. Inflation data that came in is quite tame. And thirdly is a review of the V-shaped recovery that we have been experiencing. Similar to your point, Ed, is that this is one of the most hated V-shaped recovery rally. And the reason why is, I'll talk about it later.
Okay, that's a good little tease. So with the S&P being now up over 7% year to date, what do you think about the Magnificent Seven stocks? Do you think that they're overpriced, or do you think that they're properly priced?
I think they're properly priced. Their earnings are still coming in, and compared to the dot-com run in year 2000, this is completely different because now we see earnings are actually here. Instead of the speculation of what could be, this is what is and what will be. And so comparing to the previous great bull market, I think this one really have legs.
Okay. Yeah, we'll talk about Apple here in the second half of the show as one of our stocks that we're previewing. So that'll be a good opportunity to take a look at least in that case, what is the market expecting going forward?
Yeah, the other day I was going to put out a report about staying away from the S&P because the Magnificent Seven was overpriced. But I looked at Amazon, I looked at Meta, and they were not overpriced. In fact, in some cases, you could make an argument that they're underpriced. So I didn't put that video out, but I want to make sure that everyone knows that the Magnificent Seven, even though they're leading the S&P, they're not overpriced at this point. But the S&P itself is a little frothy. I think it's selling at about 15% over what it should be. but that's a respectable number, and you rarely ever have the S&P properly valued. You either have it overvalued or undervalued. Right now it's overvalued, but it can stay overvalued for a long period of time.
Yeah, that's correct because the market participation, or just like equities participation rate, has increased. Even though there's a lot of money in the sideline, and that is basically one of the reasons why this is one of the most hated V-shaped recovery rally. Um, and the reason being, yeah, I can just go right into it, is that a lot of the institutions, they have missed the boat, okay, because they have been negatively placing their allocations for their assets. So are a lot of the hedge funds and a lot of the institutions, are they fully invested in the market? And the answer is no. If you look at the size of the money market, the amount of money market that's sitting on the sideline, and how the institutions are actually positioning themselves, you will see that it is one of the most negative moment ever in history. And so, if you look at the fear and greed index right now, it's 73. It pushed back a little bit. It was a 76, meaning it was hovering extreme greed area for a long time, an extended period of time. And if you look at many of the technical signals, they're pointing to, let's say, 1 to 2% within the range of an upcoming, short-term pullback. But we
Now,
just
Andrew,
don't know what yeah.
when you say extreme greed, is that a positive for the market or a negative for the market?
It's a contrarian measure. So extreme greed means it's at a point that is at extreme greed, which is opposite of fear. So that really jives with Warren Buffett's, famous saying that, when everyone is greedy, be fearful. And when everyone is fearful, be greedy. That is the contrarian indicator. And, CNN, started this. And I've been measuring on a weekly basis, and right now we are hovering around extreme greed. We just came down from there because right now, today, is at 73, and that is on the top, level of greed, not at extreme greed. 75 and above is extreme greed, and it's measured
Yeah, I
from
would
0
say,
to 100.
yeah, and again, just from an IVoT perspective, that again, as Andrew exactly said, when people are being greedy, you want to be careful. They're bidding things up beyond their intrinsic value. They're paying a lot for stuff. They feel like they want to get into the market. Maybe they feel like they're too late, whatever. So you've got to be careful about how much you're paying for things in an environment of greed. On the other hand, when the market's in panic, that's when you find bargains, when you find people selling things and getting out of the market for the wrong reasons or for personal reasons, whatever it may be, fear again, basically. So,
For doing this for 37 years, it's always bothered me about investor confidence and consumer confidence. And there's a huge difference between the two. Consumer confidence has to do with people willing to go out and buy things, and investor confidence has to do with people willing to invest their money. The consumer confidence has been dropping recently. Can you explain why?
Yeah, right now consumer confidence is all-time low, investors' confidence all-time high. And so, and the consumer confidence is really led by, or the drop in consumer confidence is really led by the group of people that are insecure about their job future, their careers, largely from tariffs and also from the expansion of AI, its capability, and seeing what could be. And so that has created a situation that we have one of the lowest consumer sentiment and consumer confidence data, going back to the 1980s. We're hovering around those areas, those
is that a
levels.
forward indicator, or I mean, does that indicate that we should be concerned about growth in the future, or is that something that is really just a kind of a measure of what people are feeling at the moment?
Yeah, this is more of a measure of the masses of the mass workforce, because if you could understand the haves, the habits, for the large companies, for example, with deep pockets that are funding this AI continuing growth, and also for the top earners and executives, they are fine. I mean, even with tariffs, they're just rolling it off. They're not really reacting to it. Even when egg prices, gas prices are high, that level of consumers, they're much not really, they're not really affected by it. Then there are the lower income, folks that are living paycheck to paycheck, and those are going to be most affected, especially in the white collar sector. The service sector is pretty safe. I understand that people are worried about the Korea, but within the service sector, it is much harder to replace. But they are still not too comfortable about the future Korea. They don't know where this is all going to go. For example, even drivers, they could be replaced by autonomous technology. That ultimately could happen. Will waiter and waitresses, manufacturing workers, will they be replaced by robots? I mean, slowly but surely, we're starting to see that with logistics. Amazon is a perfect example. And then yesterday, I just checked out this massage robot chair, very expensive. For those patrons to say that, hey, this does not replace human, but it's happening. So it's really the mass workforce. It's a reflection of the mass workforce. Yeah.
I saw that AI, is causing, I guess, at least the news was saying that there is a slowdown in hiring among college graduates because companies are looking at AI as an alternative to hiring out of college. I don't know if that's, how statistically true that is yet, or whether it's just, a good media bite, but, again, goes to what you were saying. I also wanted to ask, from a global perspective, I know that consumer confidence is a US based measure. Do we have consumer confidence measures for Europe and even for China as far as, what's consumer confidence? Do we have measures of that kind of data from around the world?
We do, and they're all generally trending lower.
Okay.
They're all generally trending lower because, it's really the geopolitics that is stemmed from the U.S. For example, the U.S. through its tariffs policies is really, putting China on edge, especially with China. Every other country that have made a deal, I think, will already have some level of clarity as to what they can expect. But with China, it really could change at a moment's notice. And, China is such a big export economy. So a
Yeah.
lot of the factories in China, they have a terrible problem with placing orders, especially with seasonality. One season is gone, you have that particular narrow window to place order. And then once it's gone, it's gone. And because of the current tariff situation, 1.0 and 2.0, many of the factories are looking to Europe as the new customer. And then now almost every manufacturer factories are going to Europe and looking for orders. And, that became more and more competitive. And so, client base cannot be replaced overnight. But at the same time, many of the manufacturing are not too worried about losing or them losing their presence, in this global trade. For example, we just don't think that U.S. wants to make everything, right? Do we want to make pencils? Do we want to make broomsticks? Maybe, but not all. So many of the businesses still, they believe that they can survive this for the next couple of years. And right now they're just playing defense to the extreme.
Well, this has been very interesting dialogue. But Emile, I want you to take over with the IVoT Forecaster. For all of you watching, this is one of the most important parts to the IVoT Academy, is what Emile has put together for the Forecaster. So Emile, take it away.
Sure. So this week we're doing second quarter previews of Palantir, a AI-based company with tech, which I think I'll let Andrew kind of discuss more about the company. He's more up on Palantir than I am. Ed, you as well. And then we have Apple, which I think we're all pretty familiar with Apple, and we'll take a look at where Apple's sitting going into the fiscal second quarter. Both of them are reporting in the next couple of weeks. So as far as Palantir is concerned, first of all, the stock's up 101% year to date. So obviously extremely good performance so far this year. It's up 1,500% over the last 5 years, so roughly 60% compounded return for an investor who put money into Palantir 5 years, which is, off the charts. And so, again, $100 put into Palantir today would be 5 years ago, it'd be 1,500, in excess of $1,500 right now. As far as the business is concerned, let's say, let's start there. So in the first quarter, Palantir had pretty solid, strong performance. Their cash flow grew by 100%, right? So clearly, that's a solid performance based on roughly 40% sales growth and about 800 basis points of higher operating margins. So they really were cutting costs, particularly on the operational side of the business, not the cost of goods. Actually, cost of goods went up a little bit. So if I now pull up the tool and you look at that, you can see, and I'm going to be, by the way, inputting that graphic, Ed, post this, that the current shares are trading at 147, sorry, they just opened $148 per share. And the cash flow value, according to the IVoT Palantir Forecaster, and again, we have tools for each company, is $8. So what that really means is the current cash flow value of the business is $8, and if you want to buy it, you got to pay 148. In other words, the market is expecting extraordinary future cash flow growth.
And Emile, we cannot see anything.
Right. We're going to put those in post-production, the graphics. Okay. It'll look better. That's part of the changes I've been working with my production team on. So we'll edit this little thing out, but that's fine. So the current value again is $8 on cash flow. You're paying 148. And that would mean that you would need to expect I have it there in the script. I calculated this. We would want to have roughly 166% cash flow growth over the next 3 years for it to catch up to its current share price. So is that realistic? Well, I think Andrew can talk to this, but probably, right? Meaning it just grew cash flow to 100%, and it's probably in the early stages of its trajectory in terms of the business opportunities it has in AI. Yeah. So, again, big expectations for the future.
Yeah, I can talk a little bit about that. I mean, just look at the latest quarterly earnings from Q1. I mean, the revenue grew, roughly about 40%, and the commercial revenue is up 71%. So, according to the CEO, their expansion into commercial contracts, because they made their fame by serving the government, right? And what the company does is that it's a big data analytics firm, and it helps companies to basically create an operating system using harvesting data and using artificial intelligence and cloud, large language models, and then put that all together and basically act as a consultation firm and to make the company grow or increase the efficiency and decrease the inefficiency. So that type of consultation is very similar to like Rockwell advising a factory to how to automate their system, right? How to automate their manufacturing lineup. So same with Palantir, they can do a lot more with all kinds of companies. So as Palantir is expanding from exclusively doing government contracts into the commercial space, they're looking at the Fortune 500 companies, and then when they're done with the Fortune 500 companies, they will hit the Fortune 100 companies, and so on and so forth. So the outlook for Palantir is quite high. There is limited competition that's out there, and that's really the bull case. But yeah, the market could be trading ahead of itself, and should the market face with any kind of adversity or any kind of black swan event, I'm sure that could put the projection into doubt. But other than that, most analysts seems to be quite enthusiastic about this stock, this company.
Well, that's great. So, Emile, why don't you take us through Apple, which I believe is transitioning from being a growth company to a value company?
Yeah, sure. So Apple is actually down 12% year to date. So it's quite a different story this year for Apple as a stock. That being said, it's up 130% over the last 5 years, which is solid 18% cash flow growth for a company this size. I think, honestly, Ed, that would still fall under a growth company. But to your point, actually, if you look at the share price currently, which is 200, and let me just pull it up here. We've got the shares currently trading at, at $213, which is a premium to its cash flow value. According to the IVoT Apple Forecaster, you can see that the intrinsic value of Apple right now is actually $177. So it's trading at a roughly a 17% premium to its cash flow value. Now, I'm going to take a moment just to explain what that means from an IVoT perspective. The way we look at the market price is actually that the market price of a stock is actually a forward projection. It's not based on the current intrinsic value. In other words, when we say that Palantir is trading at $150 and it's only worth $8, the market's saying in the future it's going to be worth $150. That's what you should be paying. That's the correct price according to the market. And the question will be, what is the future? According to the IVoT tools, the future's 3 years forward. So again, we can sit and model out 166% cash flow growth, and that would get you in Palantir to the current share price in the next 3 years. And that's what the market price is supposed to be. Does that make sense? Just pausing for a moment, Andrew and Ed?
Yeah, it does.
So the market price for Apple at $213 is a view that that's what the cash flow value will be in 3 years.
Correct.
It's currently, the cash flow value is 177. You're not buying the present. You're buying a 3-year, call it future of the company, because that's as much as the market can predict. According to
I think we talked about this before, is that the stock market is the present value of futures earnings.
Right, exactly.
The aggregation of present value of futures earnings. So you're buying into what is going to be in the near future within clarity with that expectation.
Right, and what we say at IVoT is the near future, the forecastable future for any company is 3 years. So somewhere in its subconscious, the market is basically saying in 3 years, Apple will be worth $213. Right now, it's worth $177. Now, Ed, to your point, that means the market's expecting roughly 6% compounded cash flow growth from Apple over the next 3 years, which is not a growth company. As you said, that would be a value company. That would be a company that's basically, I don't know, it's kind of reached the end of its high growth curve. And in the last year, cash flow only grew 6%, which is why the stock has been weak. Year over year in the first quarter, cash flow only grew 6%. So the question is, what, if anything, is going to accelerate let's call it Apple's cash flow growth to make it an interesting investment? Because anything above 6% starts to make it look cheap. Whether that be new phones, whether that be expansion of their services business. I think a big issue with Apple right now is they make much higher profit margins on their cloud, on their subscription business. Can they grow that more quickly? I think it's been kind of a tired, in a way, catalog. And obviously the biggest growth driver you would think would be AI. And again, I think there's not a lot of visibility on Apple's AI strategy at this point. And again, that's from, my perspective. Obviously, Andrew and Ed, you can pipe in. But again, I would say, Ed, that the market is actually, yes, stating exactly what you're saying, that right now Apple's being viewed as not a growth stock. It's being viewed as I guess you call it a value stock, one that you could buy and just kind of hold on to and get a dividend from. And by the way, the dividend yield, I don't think would make it warranted as a dividend stock. I'll just double check.
No, the dividend is
it's like a 0.5% dividend.
They're holding on to the cash because Apple is notorious for making acquisitions. If you look back at the previous decade, they make about 9 acquisitions per year. But Apple has been criticized negatively for they're late to the game with AI. They also have gave up the project on the autonomous car, the Apple Car project. And I just recently looked at the roster of the age of the top management folks. They're all over the age of 60. And they were criticized for not having enough young managing director who can direct the firm's positions, as to how to work its way back into this AI race. Because Apple Intelligence and AI, they have been more of a disappointment as of late. I mean, myself, I bought the, Apple 16 Pro Max thinking that, it has Apple Intelligence, but they still have failed to deliver anything substantial, right? The third-party platforms and the third-party apps that are, that I use through the phone is great, but they really don't have this new wow factor in terms of a product. Now, could they come out with something? Well, yes, the Vision Pro could improve, but they're not improving fast enough. It's still very clunky, very heavy, and you still have a wire attached to a battery. We believe that is the future, but not in this current format, not in this current form factor. They are spending a lot on research and development, and people have also speculated that they might buy Perplexity. But at the same time, it doesn't guarantee their place, to be able to catch up with the others in terms of this AI race. And so it is the revenue, it is the app store, it is the cash flow that is keeping its valuation there. But Apple needs to do something.
So, Andrew, it amazes me the depth of research you do. So you are hanging around looking up the ages of the older people at Apple.
It just came across through the feed because I actually use X as part of my research, and the people that I connect to with X, they're quite amazing. Again, they're much brighter than me, and the flow of information is just so fast that you don't have to wait for a research report. But I'll be able to produce that. You see that on the screen, and it's quite amazing.
Yeah. Well, one thing we could do, I think that would be interesting, would be, just saying for a moment that Apple doesn't spark a lot of excitement based on this conversation. However, as Andrew noted, they have a huge cash wad and would be looking to buy something. So then the question is, what are the interesting targets for Apple that we might want to invest in? Because if they're buying something, they're probably going to have to pay a nice premium. And one of the things we can do with our IVoT Forecaster is actually calculate, and that's something that we'll have some on the platform. We have lessons for how to calculate a takeout premium for a company, something I was very good at doing, by the way, as a hedge fund manager on Wall Street. I always found smaller companies that were takeout targets and was able to pretty accurately calculate where they would get acquired. And that was a very profitable source of return for my fund.
So I hope everyone has enjoyed this show. I want to thank you for watching IVoT Eye On Investing. Please subscribe to our YouTube channel. It's very important that you do that. And click on the link in the description to register for early access to the platform opening soon, which includes access to our powerful IVoT forecasters and fundamental investment training. See you next week for our weekly fundamental update on the market and our stock of the week. So thank you very much, gentlemen.
Yeah.
Thanks, Ed.
See you soon.